In a world where every VC claims to have an edge, how do you know if yours is real?
But this episode is going to be 100% about defining your edge as a VC firm, pressure testing it to make sure that you're actually as good as you think you are.
The uncomfortable truth, most fund managers are living a lie.
Make your choice. Are you going to play to win or sell a mirage?
But what if there was a framework that cuts through the noise?
Over time, we realized that the VC business consists of 4 steps. It is sourcing, it is picking, it is winning, and then it is managing the portfolio.
The real question isn't how you pick companies, it's how you get picked first.
If you want to be picked as a first step of sourcing, all that means is, hey, what activities, what edges do I need to build in order to make founders want to work with me?
Because when the best deals hit the market, there's only one test that matters.
Why will my buddy call me first and give me more time or maybe invite me to the deal that they are leading and not someone else?
True differentiation isn't about what you say yes to.
You know you have a strategy when you know when to say no.
Ready to pressure test your edge? Join Patric Hellermann and myself as they tear apart the myths of VC differentiation and rebuild them from the ground up. The European VC podcast, where venture meets reality.
Here's a few words from our beloved sponsor.
Welcome to the European VC podcast, sponsored by Flow. Combining technology and regulatory rails, Flow is enabling the private markets. For the VC market, Flow is working with integrates every aspect of fund management, from creating investment management agreements to handling custody services and regulatory reporting. This unified platform streamlines the administrative workflow, enhancing communication with limited partners and simplifying payment processes. A standout feature is the Flow Certificate, a globally tradable instrument that boosts liquidity and facilitates secondary market transactions, reshaping fund structures with more flexibility. As Martijn, CEO of Flow, puts it, by modernizing fund structures and enhancing liquidity, we're empowering investors, VCs, and innovators to grow significantly.
Yes! This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Patric, my dear friend, welcome back on the European VC podcast.
Thanks, Andreas, for having me back on.
I have been waiting for this episode because you have a different way of thinking about, or maybe not different, but I think you have a very thought out way of thinking about how you can build your edge as a VC. And I really got to feel that when I dived into Foundamental for our last episode. So for that reason, I said to you, could you not please come back on so we could talk a bit about the mystical edge of VC?
Very, very happy to be here. I'm not sure I have the mystical edge for folks. We have our way how we thought about it. Happy to share it, but I'm sure there are other playbooks that will also work.
Yeah. So if I should just add a few words to those that think, what is Andreas talking about when he says the mystical edge or the magical edge? What I, of course, mean is that we have done more than 300 episodes now, so many with TPs, so many with LPs that all say the same thing when you ask them, what's most important in your fundraise, or for an LP, what do you look for in managers? The answer is always the edge of the VC firm. Why? And then they say things like, why do you exist? Or why do founders pick you? Those are the things that they always zero in on. And very often, and this is funny in connection to what we're going to talk about, because very often people come with an answer that sounds like their value add. And so I thought that maybe that was what you were going to go into. And then you said, no, this has nothing to do with value add for me. So I said, that's good, because that's an answer that you get from many. But so just to summarize to everyone, the reason why I'm talking about this magical edge is that it's what every LP says that they're looking for. But it always leaves at the same time people or listeners a bit confounded with, well, what is then an edge? What makes up an edge? And that's where it can sometimes get a bit fluffy when you ask both, to be honest, VCs and LPs. So for that reason, I thought let's bring on Patric, because I think you have a very thought out strategy or thinking around this. So here we are. This is the episode. We're going to dive into Edge. This is one perspective. As Patric just said, this is your perspective. Not everyone's, not the only way, but it's at least one good step at it. So let's take the first step and look at the fundamentals of your business. You're saying, think about VC in this way. So this is how I'm going to frame you. Now, please pick it up from there.
So I first want to, and Andreas, I should say, by the way, when you approached me with this question, when someone asks you that clearly the way you did, it forces you to really consider and reconsider, hey, hold on, how have we approached it? So I thought it was very thought-provoking and quite interesting. So that's one. And two, I just want to give context before I answer the question. So with Foundamental, we're vertical, early, and global. So we invest vertically in 4 or 5 sectors that all touch towards us building infrastructure, building buildings, renovating buildings in the world. We do that globally and we do that early. So that's just important for context, because what I'm about to say might be completely different, or a different playbook might work for you if you're in a specific continent, growth stage, generic, right? So our story is the following. Now, when it comes to the fundamentals of your business, I think over time we realize that the VC business consists of 4 steps, and there's no other steps to value creation that we as fund managers actually drive. It is sourcing, it is picking, it is winning, and then it is managing the portfolio. That's it. You can't dumb it down any further. It's sourcing, picking, winning, and managing. And sometimes I feel like when you think about your differentiation, I love how you said it. You're actually thinking about, hey, in the management stage, how do I add value? For example, maybe it's introductions, etc. But actually, the way you create value on your portfolio might happen at the very front. It might happen in how do I actually source companies at great terms at a point in time when I have no competition and I have the time to then thoughtfully pick them. Like once you start framing VC from that angle, we kind of realize that, hey, maybe that's what differentiation is about. How to find companies without or as little competition as possible with the time to diligence them. So that's what's behind this process of VC, how we're thinking about it.
Yeah, I just noted down a sentence here, which is that the edge is the competitive advantage in each of the 4 stages, so to say, the sourcing, picking, winning, and managing. I think that's actually a good way to sum it up. Like if you should say to anyone, when an LP asks me about my edge, what should I answer? Your answer should be a quick description about your edge in the sourcing, picking, winning, and managing parts of the business.
I think so. This is also a place where I feel like I should give a shout out to a person that influenced my thinking here a lot, but I think he doesn't know that he did. So years ago, I spoke to Walter Gort, one of the founding partners of Atomico, heavily involved with Hummingbird, great angel. And Walter, at some point years ago, he asked me, hey, Patric, how do you pick companies? And in my VC mindset, I was like, well, here's what we're doing in order to get into the best companies. This is the strategy I have as an angel, etc. And he reminded me, no, that's not what I asked. I didn't ask how do you source or how do you win. I asked you, how do you pick companies? And that's the shout out I want to give. I think Walter is one of the smartest people I have met that has really taught me and influenced me without maybe even realizing it, that our business first and foremost is about picking. And that relates back to the process because, for example, imagine you can find a differentiation that makes you being picked by the founders before you even pick them. Your whole sourcing game changes because now you're not reliant on events, on hosting dinners, on outbound brute force, or on making as many VC friends as possible. If you want to be picked as a first step of sourcing, all that means is, hey, what activities, what edges do I need to build in order to make founders want to work with me? So that was something very influential for me from Walter that transformed how I think about sourcing in the sense that, hey, what will make founders pick me?
And we're going to talk more about that as well. But let me ask you, because you're also saying make your choice. Are you going to play to win or sell a mirage? So this is obviously a controversial statement because no one will ever want to sell a mirage. So I know that when you're, or at least not admit to it. So I know that when we're going to talk about this, you're going to say, well, I think that there's many VCs that in fact do sell a mirage, even though they package it as something else.
So I'm a fanboy of Point 9. The Point 9 guys know that. We only have one co-investment, but I admire how they have built the platform over the last, I guess, 15 years. And one of the many reasons why I admire that and the way they have built the company is from the outside in, and with the touch points I have with Ricardo, Louis, and Christoph over there, my impression is that they pick in order to generate DPI. That sounds intuitive. I'm sure when folks listen to this now, yeah, but what's insightful about this? Well, actually, when you observe the venture world, ask yourself, is that really the norm in venture? Or is the norm perhaps in venture, hey, let's first be in the game. Let's be on the playing field by fundraising and making AUM. And then I need to spin a narrative in order to justify and earn the license to operate, to fundraise. I actually observe venture to be first and foremost about that. Be on the field by having AUM and then kind of figure out how to win deals. You know, perhaps I'm the fastest, perhaps I pay the best terms, etc. But if you truly approach it from, hey, I want to generate DPI, and that's what everything else, your entire strategy, your processes, your fundraising narrative derives from, everything becomes a little bit different. And so that's what I mean by that. Do you want to first start with a mirage in order to get AUM? Or do you want to first think about how will I generate DPI and then from there derive my strategy? And that's what I admire about Point 9 as well as others.
So let me just ask you, Patrick, because you are describing here that some be on the field game rather than the investor get DPI. I think most would actually, I don't think many would commit to the first thing, even though, you know, when you describe it, you could maybe argue that that's what they're doing. But I don't, if you were to give a VC that's unsure if, am I selling a mirage? You know, what would be the tests for it?
So we're getting already towards the end, but I think I have 3 or 4 tests in mind, but one of the tests actually is what you and I in our pre-discussion called the buddy test, right? So the buddy test is, hey, if you ask yourself, if you say you win the best deals, you source the best deals and then you win the best deals because of introductions, because of your network, through your buddies, then actually the question that you need to ask yourself is, why will my buddies call me? Because your buddies will need a reason to actually call you and not call any other buddy. So the whole argument of, hey, I have the best network is in itself not a differentiation because you're not the only person that is that person's friend. Which means that why will my buddy call me first and give me more time or maybe invite me to the deal that they are leading and not someone else? That's actually a very, very interesting question. And I'm not sure, you know, we're asking ourselves that all the time, often enough. But when you do, and you do have an answer for it, then maybe you're playing to win because maybe you have found a differentiation that your network appreciates. But actually, if the question is, well, because they know me well, or, you know, because we're good friends, well, I'm sure they are friends with others too. Then, you know, the follow-up question is, okay, is that enough?
Yeah, I honestly think so. If I were to give my take on that, I would say the thing is, if you ask yourself, not do I get a lot of deal flow from friends or from my network, but rather the people that I get deals from, do I always get the best ones? Am I the first guy they reach out to?
Yes.
That is where I think that there's a lot of people that would realize maybe not. And I think, and that's probably how I would describe the body test, right? Because it's so, you know, I think it's so difficult to introspect and say, do I have something special? Because everyone will very quickly think that they do. And they would also maybe very quickly fall to say, well, I got the deal right, or I got the starter right, so obviously I am on that list. But I think the thing is, 1.9 does have that deal, are they calling you first or not? And are they within a specific field? And that's of course where again, you're specialized in buildings and the built world. My good friend Anthony Dannon is one of the leading investors in fintech. So anyone who does something in fintech will go there. And I think that that's where people need to ask themselves the question, because maybe back to being on the field and actually playing, as soon as people know you're in the field, you're getting deal flow.
It's so interesting, Andreas. I want to run with that because it's so interesting the way you've just phrased it, because you're sort of leading us in a direction of like, what do you think the venture industry will be in 5, 10, 15 years from now? Because actually all the arguments that you just made is, hey, me being the right one to be called upon or the first one to be called upon is context specific. Because it's very unlikely that as an investor, I will be thought of for every deal out there, for every context out there, as the right person to call first. It's just unlikely. You just said it with Anthony for fintech. Maybe I'm that guy for someone in construction tech, and so on and so forth. And I'm exactly the same, right? So I have deals where I invite people to follow our lead for certain models, and then for others, I might think of different people. It's so context specific. And the buddy test will reveal that.
Yeah, and I think that it's incredibly, like I asked the question the other day in another episode, I asked our guest, do you think that there's still room for the localized player, but without vertical focus? In the sense that Berlin used to be so cut off of other ecosystems that you could just be the first person that anyone in Berlin would go to. And I am unsure whether that position still exists in any ecosystem. And honestly, hand on my chest here, I do not know the answer, but I know that I've started getting queasy about that just from me observing the ecosystems that I know best. Say, for example, the Danish one. I cannot see why any great founder in Denmark would not very quickly be looking for investors outside of Denmark. They would also meet the ones in Denmark that are of high repute, but it's so easy to reach the others that I don't think anymore that you can say, well, I'm the point of, like, if you're a pre-seed startup in Denmark, you're gonna come to me. Not necessarily. I don't think so. And for that reason, I think that and you can obviously see that in that all the Danish funds, the majority of them, have shifted to being now New Nordics focused or whatever frame it as today, Nordic noir. I don't know if we're film inspired or what we are, but I think that is really one of the very important things to think about as a manager. That buddy test has gotten so much harder, I think.
Yeah.
And that's why this episode where we're talking about the edge is so important, because I do think that you need an absolute perfect answer to all four to be picked in this current market. And I do think that if you don't have that, you'd probably do better to look yourself in the eye rather than a bunch of LPs in the eye and make your decision based on that.
So what you just described also with a geographic proximity, I have a feeling it has to do with when a company becomes obvious at longer distance, right? Longer distance being, I'm a US investor looking into the Danish market. What are the signals that I need at long distance from a specific market for a company to be obvious? I'll give you 2 or 3 examples. So in Australia, there's Blackbird. Blackbird is, if you've never researched them, they publish their performance. It's an insane performance. They dwarf most Silicon Valley firms, more small AUM Silicon Valley firms in performance. Blackbird, in my opinion, completely owns Australia. And that's because there is proximity. There's lack of proximity to that market. Israel, I mean, anyone who would research Israel finds that, hey, maybe the pre-seed rounds in Israel, the great ones, in the end get done by Israeli firms. Why is that? Well, maybe there's a proximity element, maybe not temporal, maybe not spatial, but maybe cultural. I don't know. And then the third one is the vertical element. I mean, if you're a vertical specialist, you try to be very proximate to the markets that you serve, and you try to be, through repetition and routine, earlier in conversations with founders, where ideally a founder tells me, Patric, you get it, and others don't get it yet. So that's the game for me. If I want to be differentiated, is, hey, can I invest in companies before they are obvious at distance?
And I think that proximity distance ratio is worth thinking about, on the many different elements. So there's the network element, meaning how plugged in are you to the venture ecosystems? Because you can be super non-proximate, super distant on both vertical and on geo. But if you're network connected, you can be wherever you want, so to say, you'll still be able to do it. But if you don't have network connection, you need to have the vertical connection or the geo connection. And you can probably then argue, which means that if you're in a very emerging ecosystem, you can still be just a geographically proximate person, because it's so hard for everyone else to spot them, because they're lagging both obviously the geographic, but oftentimes also the network, and oftentimes also the network, because if you're an emerging ecosystem, everyone's disconnected, so to say.
I couldn't agree more, and you're pointing out another fascinating fact. So if we go back to the process, right? So sourcing, picking, winning, managing. If you now take everything that we just discussed into the picking stage, imagine let's use trans-European fund. The reality oftentimes is that your fund is born in one country. Your GPs will have oftentimes the empathy for one country, and the IC, as a result, oftentimes has repetition and routine in one or two countries. And now what happens is, at some point, you're like, hey, we don't have enough from the Baltics, or we don't have enough from the Nordics, or France is such an important market. Why can't we win great companies there? It might be because in the picking stage, actually, the way your firm is set up from a routine repetition perspective within your decision-making, within the picking, that actually the distance to a specific country, you as a satellite partner, you might not have it, but the partners that you need in order to come to a great picking decision, they might have that distance to that company before it is obvious. And so that's something that, as a vertically differentiated firm, you can use to your advantage. Because if you truly gain routine and repetition in something, be it, like you say, in a specific geo, in a specific vertical, in a specific model, but I love VCs that are focused on open source. It works perfectly, in my opinion. So in any of these, if you gain repetition, routine, and then you have that across your partnership who's making the decisions, even at geographical distance, you will still come to great agreement on which companies are worth picking.
Can I ask you then, so let's tie this to Foundamental. You just described it in the beginning. You're vertically focused on construct tech, or AECS, I guess is also the word. I'm trying to be specialized, smart here. But in normal language, just construct tech, you are at this, and then you're early stage, but you're also 3 GPs, and you're across the US, Europe, and Southern Asia. What do you call it?
Asia Pacific without China. Yes.
Without China. Southern Asia for me.
Sorry, I'm just saying because there's Australia included in there. So.
Okay. Yes. Okay. So that's what we're missing with South Asia. Okay. Yeah. So the decision to have that partnership, just if you reflect on that, the distribution of the 3 of you globally, one, you're still vertically focused. So is that, in fact, what you're saying, construct tech, we do need to have somewhat global representation, or at least someone that can fly quicker or be more embedded in the networks, even though we are vertically specialized?
For us, that's what it is, because all 3 of us share in certain routine, certain repetition. And then over time, if you do a good job, which we like to think we're doing, but that's obviously something we have to prove to ourselves every day. If you're doing a good job at it, then a certain core of shared beliefs and shared convictions out of that routine emerges that allows you to say no to specific things very quickly and say yes to spending more time and more resources to other things that you find interesting. I do think there are other fixes to the exact same thing. The way SUSE Ventures does it, I also absolutely love. So SUSE Ventures, the way they've structured their platform lately is that, hey, every GP has their own strategy, and there's exactly a one-person investment committee. There's a person that gains routine in pre-seed, seed in the US. There's a person that gains routine in Series A's here and there, right? And so I do think you're losing other things. Everything in life is a trade-off, and I'm sure we have our trade-offs. But I love how it allows you through repetition and routine to be picked by founders and then to come to picks that emerge from routine and repetition. And to me, those elements are very key to your differentiation as a VC firm in a world where capital is abundant and mega platforms such as Sequoia, etc., become ever bigger, because that in the end is the lion cage in which I need to be fed.
Yeah, and that's exactly the next thing that I wanted to ask you about, because I know that you say the VC can be a full cage of starved lions. Tell me a bit about what you mean with that.
So I've noticed how when we interact with US LPs, for example, I'm experiencing exactly what you described, Andreas, is, hey, but how do you win deals? How do you win deals? And the answer is, well, actually, winning deals happens way earlier in the process if you do a good job at differentiating, if you tell your differentiation, if you appear differentiated towards founders, because if founders pick you, then you're already at a stage where maybe I don't even have to fight over the meat. So I imagine the following image. The cage is full of lions, 1,000 lions, each one represents a VC. And now someone throws a piece of very well-tasting meat into that cage. What happens? Well, 1,000 lions will fight over it. And that's the LP perspective sometimes. Hey, so how do you become the strongest lion and win the fight over that meat? Well, actually, to win the fight over that meat is to influence the person outside of the cage that holds the meat to give you a part of that meat without even showing it to the others. And that's differentiation.
And that is exactly what we're going to talk about now, because you have 7 questions that you think are the ones that you need to be able to give a positive answer to. And that's your core thesis on this whole topic. So let's get into them. The first one is empathy. Tell me, empathy, what do you mean by empathy? Let me just say the 7, or maybe you should. The core thesis is that there's 7 questions that will maximize your chances to get picked. The first one is empathy, 2nd, routine, 3rd, distribution, 4th, arena, 5, players, 6th, liquidity, and 7th, discipline. So now we're going to go through those 7, and I'll let you start on empathy.
And again, I just want to remind before I go in there, Andreas, this is not the playbook. This is not the mystical edge. I'm sure there are different playbooks to reach differentiation. This is one how we think about the world, among others that I'm sure have worked for other people as well. So with the empathy, one of the things that we found out about ourselves as we went along was, hey, actually, we feel like the preeminent team to build a VC firm verticalized to the spaces we do. And that has to do with our backgrounds and the set of experiences across a spectrum of experiences that we've made. I come originally from energy economics. Then I went into renewables and helping Chinese companies actually consolidate the renewable space. Then I spent more time on B2B mobility, B2B industrials. And that has taught me a lot about how industrial B2B markets work, about the nitty-gritty details, about how important human relationships are, all of that. While my 2 partners, one of them is a B2B marketplace expert who led the original seed round in Zwork, for example, and the other one is a B2C marketplace expert. And so with that spectrum of experiences, we would have had zilch empathy for deep tech, for healthcare markets, you name it, right? But so for this kind of market where B2B is, 98% of the market, where nitty-gritty details are very important, where the supply chains are a bit chaotic, So that set of experiences helps you to have an empathy for the day-to-day of the customers and the suppliers. And so that's what I mean here. So if you don't bring prior empathy, ask yourself, how likely is it that you truly are the perfect fit to build a differentiated firm? If your past experience, your close network fits to the markets you want to dedicate to, be it geographically or vertically, then you might have a good starting chance to have some unfair empathy.
Yeah, and empathy, in other words, is what we all know, so to say, as vertical expertise or expertise in the space in which you want to play. Now let's go routine. It's very close to empathy, but there is a nuance to it that I think is important.
Exactly. So routine for us is about seeing ideally the same thing, but in different nuances over and over again. We oftentimes get asked, hey, so why did you go global? How do you source globally? How do you manage with a team that small? All these global deals. And the answer is repetition and routine. The no's that we get to after, and you notice it every year. I would say the time that it takes us to get to a quick no becomes shorter every year. Simply because at some point you will have seen the same pitch, the same models, etc., but in different market contexts, 10 times, 20 times, 50 times. I'm sure there are some that we have seen 100 times. And so if you're let's say, generic investment model in a specific market, you might now say, hey, but I have the same thing, right? So I have seen the exact same company pitch me 50 times, etc. But the difference is the market context is not different. It's always within the same market context. And so when you change the market context, because you look at a similar market but in different geographies, we believe it's that level of incremental learning within routine that makes you spot the unique things. Because to this day, Inframarket, one of our biggest hits in our Fund 1 portfolio, has not truly been repeated across the globe. And yet, generic VC friends of mine have tried to back the exact same model in other markets, and it did not work. So it's the change, it's the repetition against changing market context that I find so fascinating.
If I should just add to it, because I think that's one angle to it. I think it's one angle to it that it's repetition on the same asset in different markets. I do think that it's fair to say that, at least this is how I think about it, and I think it's fair enough to say that it's having repetitions in your space, and that is both in terms of the types of deals you see, but I actually think that it's in every little thing of being a VC, and that's at least my angle to it, that there's nothing that can be compared to having many repetitions in something.
I agree.
And more specialized you are, the more quickly you can build up a lot of repetitions in that specific thing. And I definitely can get why you're thinking, but that's also because you're thinking very much from that picking angle that you started out with. That was so important to your whole framework. I often think also from a firm angle, and I do think that it's as a firm also incredibly important that, as an example, you individually have had many repetitions on something, but if you're joining up with a partner, you also want to have repetitions together, because too often we see small teams fall apart or young teams fall apart.
I agree. Sorry, Andreas, I have a provocative question here that perhaps you and we can't answer it right now, but I just find it fascinating. So without having the answer, how often is it being discussed in venture? Emerging managers in their first funds deliver the best performance. That's a broadly discussed topic. And so oftentimes what's being cited is two reasons for that. If you listen to the public debate. One is, well, they haven't made their money yet, and so they are more hungry. I think that's a lazy argument. Perhaps that is a factor, but to me, that doesn't explain it. Unlikely. And the second one, well, maybe at that stage they were just smaller funds. I think that is absolutely a factor. But what if I'm actually not as successful in Fund 5 as I was in Fund 1, if it's the same AUM, is actually a result of me actually not benefiting from routine from Funds 1, 2, 3, and 4. Because if I pick a generic strategy then every fund vintage, a new theme, a new fad of the day will come along. And perhaps I don't actually get to benefit from the learnings that I had in the themes that I picked in Fund 1 or the successful themes that I picked in Fund 2, and they don't carry over into Fund 5 because I don't use repetition and routine on a topic. I don't know. Maybe that is an interesting factor to consider.
So what do I think on this? I think that first of all, it's very rare that we see anyone ever sticking to their AUM, even if we think about the inflation and thus that would allow for some fund size growth. So I think it's we probably have an N of 0 there that have actually done that. So I think it's very hard to follow that line of thought. But what I would say is that I think that as a VC is so centered around outlier performers, both in the portfolio, but I also think that on the individual. So the individual investor, the person that can be an investor. I think it's very, very hard to scale a venture firm with employee, junior, mid-level people without at the same time also specifically, intentionally growing AUM so you can also justify lower performance on a returns basis. Meaning that why can you have a big fund that's justified that it has lower returns? Because you can put more money into that one manager, and thus your dollar amounts that come back justifies that the multiple is lower. Because it's you can't fill a portfolio with 10 million funds or 10 million euro funds or 20 million euro funds. No one has the time for that. Almost anyone, right? So for that reason, you would actually probably rather, or in many cases, you would say, I'd rather go with a larger firm where I can put more money, but where I then know that obviously it's not going to be a 10x or 15x or whatever, which I might get in a lower fund size. But here I have a machine that I can put more money into, and I know that it'll come back with a quite big certainty. I don't think you can have the outlier performance when you have a lot of junior and mid-level people that by definition are not outliers. But that is what you can get with a very concentrated bet on one person. The problem is just that it is incredibly difficult to pick VC managers. And you also, even with the smartest guy, have a very large risk if that's 30 investments and it's only 30 investments. And he can have the Midas touch and still not hit the right one. So for that reason, I think that the important thing to think about when you're thinking about AUM is this justified? Are you justifying the fund size increase and lower returns expectations with a de-risking of what you're doing because you're more solid, so to say, of an institution? So that was a long walk down how to think about AUM. But I do think that that's, if I was an emerging manager thinking about, do I want to be one person, two person, three persons, do I want to have 5 principals and 7 associates, or do I want to be just the 3 of us? I would 100% think very seriously about what am I doing to my AUM ability here, or my ability to return risk-adjusted or give good risk-adjusted returns versus my ability to just deliver raw DPI or raw MOIC, actually, because DPI you can do more of with the other, but multiple on whatever someone entrusts you with is easier when it's a smaller fund. Yes, so that was a big ramble. I hope someone got something out of it. Now let's get into, so we just spoke about routine, the importance of building repetition in your game. Let's talk about distribution. This is obviously something that I care a lot about, but you're asking what makes your ecosystem realize your game and think of you first. That's distribution in your mind.
I first want to start with the topic of distribution when it comes to the founders that we all back, right? So there's a saying in the military where something like, and I wasn't in the military, so I'm just following it, but I can't speak from experience here.
With the current discussions about Tim Walsh, you have to absolutely disclose that whenever you make a metaphor or a story about the military, say, I have never been in the military.
I was not 24 years in the National Guard, and I was not deployed to Iraq. So I'll make that very clear here. But been following it. So it seems like in the military, they have this saying, right? So where they say, hey, armchair generals talk about strategies and tactics, and the veterans talk about logistics. And I feel the exact same thing is also in venture. Like armchair investors talk about models and product, etc. All of that matters. But actually the veterans that I talk about distribution. And it's interesting, right? Because if you think about all the category creators that might be visible to you, how many of those have a true distribution flywheel? I would say in the ones that I have identified, all of them, 100%. And I think the exact same question is not asked enough about you as a fund manager, that you should ask yourself, okay, how do I actually distribute my differentiation, my message that differentiates me to my network, to my founders, to people that, my buddies that need to call me? How do I distribute that? And so the answer can be multifold. So there I don't have a silver bullet, etc. But I do think this question doesn't get asked often enough, right? So don't be the armchair guy or gal. Be the veteran and ask, okay, how do I distribute my message? How do I distribute my differentiation? There's this one fund. I just want to give it as an anecdote. Or as an example, there's this one fund. I've never interacted with a GP because he does mostly B2C, no Venn intersection with what we do. But, I looked at his fund as an LP. That's how I got the fund deck. And this guy, his entire LP pitch deck is 100 pages of the merchandise he produces for founders. Absolutely insane way of distributing his own fund to founders. And then through that distribution showing, hey, actually, your logo could be on my merchandise. Or here is all the events where I can distribute your company, B2C, again. And so that's an anecdote, right? So how do you distribute as a fund manager the differentiation that you seek?
Yeah, obviously, I've been in many distribution conversations with emerging managers, given that we have a podcast focused only on this, and also that we do what I would call strategically aligned investments for EUVC. So when we do LP investments, we often back people that have realized that whatever we're doing is an important distribution channel to them. So that's why there's a match made in heaven there. And that's also why some are better fit for us than others. So I can only say that I completely agree. And I think that you said an important thing, which is the flywheel, because any emerging manager is more than anything constrained on their own resources. And if you don't have a flywheel around your distribution so that everything you do, and even as a manager, if you don't have a flywheel around how your firm works and how the different things interlock, you will run out of time. And again, if we go back to Anthony Dannon, I don't know if you'll love me or hate me for mentioning him multiple times in one episode, but what I love about his model is that, his whole portfolio model is built around his edge being the one who interacts with probably most early stage fintech founders, even before they get started. And everything from portfolio model to network to his communication to ticket size, everything that he does is aligned around his way of investing. And you can do it differently, but pull out one part and change, as an example, what he does to a more concentrated bet, like a very concentrated study, would not work.
It doesn't work anymore. I wholeheartedly agree.
And that's where I think that it's so important when you think about distribution, thinking about how does it not become a marketing cost for you to do distribution, but interlock with everything else that you do.
Yes, because in Anthony's case, I would even argue. So Anthony and I, we have many shared friends. I don't actually think I ever interacted with him, but I know him through many friends. And I think the one thing that I would say applies from our discussion to Anthony within his specific context is he gets picked. he doesn't have to, he's not the starving lion in the cage, because he actually moves upstream of the competition. And I think that's exactly what you're pointing out. So if your entire model is derived from this mindset, you can find this level of differentiation.
Yeah. I think, one day I'm going to collect pitch decks from all you guys and put them on our website, because I think everyone needs to see what a good VC deck looks like. But it's hard to come by, unless people, if you just put on your LinkedIn, you're an LP, you can get them sent all the way. Emerging manager hacked you right there. So let's go to arena, picking the arena that you play. Tell me a bit about how you think about that. This is, so together with this episode, we're going to put out stuff, and in this connection, or tools and resources, so to say, and you should definitely check here how Patric and his team at Foundamental picked their thesis and picked their space, and how they argued to LPs, so to say, and even to themselves, that this is a space that's worth putting our fund size into, our team into, all that.
So the arena, we use this fancy term, but in the end it describes you as a fund manager, as a GP, having to make choices on the geographies, the markets, or the themes that perhaps you want to focus on a little bit more, and then the stages. It's these three things. You literally will have to decide these, because it will make you better or worse in deploying, and then it will also appear more or less likely that you can return DPI to your LPs, depending on which choices you make about the arena: geos, themes or markets, and then stages. And I think everything that we've discussed up until here, empathy, routine, and distribution, informs your arena picking. Because if you have a specific unfair empathy, and you believe that empathy allows you to gain routine and repetition faster than others, earlier than others, and then you perhaps have a specific distribution angle, that might already tell you where you should deploy your capital. And this sequence, to me, was for Fundamental very important in hindsight. I wish we had approached it exactly this way, but in hindsight, we were lucky that we did. Because if we had started with, let's do growth stage in this market because this is where currently the music plays, we might never have had a specific empathy for it, or we might have never had any repetition to draw upon, or we might have never had any distribution advantage that plays in that. Because if I start with that kind of mindset, to me, the analogy is what I love to tell founders that I work with. I love to tell founders, hey, if you approach your company building from a top-down market picking perspective, you will be in narrative telling mode, because you will be saying to VCs, oh, we're the AI for X, or we're the open AI for X, because you think that's where currently capital gets allocated. But maybe you have absolutely no reason to play there, no license to operate, etc. And that's the equivalent of starting with the stages, markets, geographies where you think the most capital will be deployed, but you not having an empathy. So I think the sequence that we've been discussing up until here should inform which arena you play in.
So I'm incredibly opinionated on this.
Let me have it.
And I am, because there are so many VCs that, we all have a plan until the first boot hits the ground. And that is fair enough in so many different parts in life. But I think that I always put it as, you don't design the VC firm that you want to build. The VC firm that you need to build is the one that you have kind of arrived at, so to say, for your life. And yes, then you can decide whether you want to do a concentrated portfolio or a broad one, a large one. But you just cannot say, right now things are happening in sustainability, and then we change our strategy to be a bit more sustainability focused or so on. Or if you just don't see an absolutely clear line from everything you've done into now launching a firm, so that you're just plugging LP capital into everything you've built so far, so to say. And it might be serendipitous. It's oftentimes serendipitous, but if you're not building on top of an installed base that you've built for the last 10, 15 years, I doubt anyone will ever be a good VC, a good emerging manager. That's also why, coming back to the fund one that we spoke about, why are fund ones often so good? Well, oftentimes they are someone who have had this buildup and then finally unleash it into the world with a fund one. So they might have the craziest backlog of 7 angel investments that are rolled in, or they might have the biggest network from their last large firm they were in, where they haven't been able to do the investments within this thesis because it was too weird, too niche for the firm they were in. And now they just, there's too many opportunities. They can't not do it anymore. No one else is placed in that arena. So for that reason, they're getting into it now. And they're getting the LP capital to allow them to do it, because once you describe that story, you can't unsee it. I think that's also part of why firm ones are often so good, or fund ones. So I'm incredibly opinionated on exactly this, because I think that if you were not made for the fund that you're building, I don't think that you can do it.
I love hearing you say that. I haven't heard it expressed that succinctly, but I agree the way you say it. Another saying that we have in Foundamental, whether it's right or wrong, it's just our conviction. So VC is notoriously unscalable. The only thing in VC that scales is knowledge. It's the only thing that scales. If you think brand scales, think again, because actually the brand value gets diluted every year in VC. The more money comes in. If you think your network scales, it's untrue. Your network does not scale. Your network at some point will not accept more intros from you or more recommendations from you, simply because curation implies that it's curated. And the more you give curation, the less the value attached per curation. So your network will actually not scale beyond a certain degree. We believe that the only thing in VC as a fund manager that scales is knowledge, which goes back to your point and also goes back to the question of, hey, maybe Fund 5 at some point for a horizontal generic VC firm is also less likely to generate Fund 1 return, because at some point you might veer away from the knowledge that you have used in Fund 1. So that's why we say knowledge scales.
So I don't agree with. I do think brand scales. I think A16Z is a great example of it. I think Seed Camp in Europe is a great example of it. Just to touch on the or counter the example of a Fund 1 or Fund 5 that won't return Fund 1 type DPI. I think Seed Camp is very well positioned to do that, and they're exactly as you said, and a broad portfolio play with a generics or whatever you want to call it, at least not sector specific firm, and that's because brand scales. I think firms scale as well, but it's up to a specific level, right? But then, to be fair, are they going to generate the same as Fund 1? Probably not, right? Are they all colors, Reshma? It's very hard to mimic the founders of any GP firm or any VC firm. I think that the GPs that break out to build their own thing, oftentimes are absolute enigmas. And I think it's very, very hard to scale that, without losing something. But then as long as you gain something else, which is then the ability to take large checks and return large dollar amounts, then it's all warranted. Okay, now let's go. Players, is it actually a game if you're the only one in the arena? That's a big question, and one that I'm going to really enjoy to pick apart, because I know some stories there from the LP angle.
The question to ask here is, hey, if you're the only player in your arena, going back to the arena question we just had, are you really playing to win? Is it even a game if you're the only player in the arena playing, ping pong against yourself? My answer is probably not. And so what it means, or what it implies, is that for your differentiation and the way you set your differentiation against picking your arena is, if the arena is void of any players, maybe it's not an arena worth playing in just yet. Maybe you're too early. Maybe it's just not an arena. Of course, you also don't want to be in an overcrowded arena. At least most people would say that's something that would not allow me to execute on a differentiation. And I think that's the question to answer here. If I pick my arena, let me validate that I will have competition that might be on a similar focus than me. But then my differentiation is, how do I win against these, whatever, 5 that do that? In Construtech, we were not the first Construtech fund. When we started in January 19 with Fund 1, there were 4, maybe 5 in the US that had dedicated to Construtech for 5-6 years already. And it does serve as validating the category. It does serve as preparing the soil to adopt more water, adopt more seeds. To your point that you have educated me upon last time, also it allows LPs to actually benchmark GPs. So there's many benefits to having players in the arena and being not the only one, because the conclusion, hey, if I'm the only one, I'm differentiated, that would be the wrong conclusion.
Yeah. Well, I'm sorry that we are in agreement. I thought we would be in agreement. But that's exactly the LP angle that you would normally have, that you would normally see is you need to see, obviously there are, anyone can make anyone make an exception. You never know. But in general, as a sophisticated LP, you'll look to see that the category is validated, that there's actually someone you can benchmark against. Also, because this is this is VC, so we're all contingent on having follow-on funding. You can also just see financing risk be huge if someone does something too specific. So I think that would be my point on the players part of this question. It's dangerous to be in too small of a niche or too nascent of a niche. Now let's go to the next one then. This is the second to last one, liquidity. You're asking the question, why will your game minimize time and maximize probability to DPI?
I mean, you literally already read the question, and I think there's not that much to add, except I don't think GPs, when they start their funds, actually ask this question. I would take a gentleman's bet if someone had godlike visibility over what's going on in people's minds, which nobody has, but I would take a gentleman's bet that 8 out of 10 GPs, before they start their fund, do not ask the DPI question. I would take that bet. And I think that's the secret here is, hey, if I do think my fund strategy, the arena I pick, the empathy I have, the routine I gain, the distribution advantage I have, will minimize the time to DPI and maximize the probability of DPI. When you answer that positively, I think you have a very strong differentiated strategy. Oftentimes, though, and that's me being critical of our profession, we go back to Peter Thiel's professions and say, oh, but we're in a power law game. And all I have to do is hit that one outlier. Honestly, Andreas, and this is me being very opinionated about our own profession, I actually think that is a super lazy excuse to avoid any kind of accountability and making rash decisions. Huge market, I love this founder, let me pile in. Do you see Sequoia is leading? Actually, that tells you nothing about DPI. It tells you nothing about your contribution to that DPI. I have companies in the 3D space that is an insanely liquid M&A market where some of them, hopefully, in that market can drive outlier returns, be the next Autodesk, for example. But it's interesting how many of them generate 200 to 600 million exits. If I, with a 50 million fund, buy 10% in any of these, because the market is super liquid, I have the best network to the strategic acquirers. I have a track record of curating highly well-performing firms with strong products. I can actually positively influence relatively large outcomes at ridiculous revenue multiples in that market. So I'm using this as an example, and there are many markets like this where, hey, don't be lazy. Don't go, oh, everything is power law. It is, but you can generate DPI below power law. It's just that people don't tell you that.
We have in our community, we have a series of sessions on portfolio modeling, and there, that's exactly, you know, this discussion that we're also having in those classes. Do you have to, so to say, strike for the outlier every single time? You might argue that you would when you invest, when you underwrite the investment in the beginning, but the actual portfolio of a very high performing fund will oftentimes have not just this one big outlier and then the others, especially in Europe, especially in sectors where you don't necessarily go the IPO route, because that's where you generate these absolute power laws. But when you have many of the verticals, many of the exits that we're seeing in Europe, they don't have that. That's exactly what you described. It's the 200, 300, 500 million euro acquisitions that then were much less dollar or dollar hungry. You burned less cash on the way there, which can then generate great returns. It's super hush and dangerous to talk too much about, I think, because it can make. Now, it's important to say because it can make people think that then we need to open the playbook of private equity. And that is not what we're saying.
That's not
still
the message.
VC. It's still VC playbook, but it's just that when you get to the exit side of things, the game changes a bit and it becomes a bit more like a private equity play, so to say. But it doesn't mean that you all of a sudden in the sourcing stage and in the winning stage and the covenant stage want to play a PE playbook. But it does obviously in the portfolio mix look a little bit like a PE play.
Here's another fun to that point that you're making, Andreas, that I've learned to admire. So a friend of mine that I worked together with when we were at E.ON, the large utility, this is, 12 years ago, we were colleagues, had lost each other out of sight. And then all of a sudden he emerges as a partner at this Dutch VC firm called Set Ventures. Set Ventures is a Series A fund, right?
We've had them on the podcast.
Sorry, come again?
We've had them on the podcast.
Amazing firm, right? And hyper focused on energy. And so the point is, so energy is a relatively liquid M&A market because there is a lot of capital from strategics in that market. And the strategics operate in a very fast changing industry. And so SET has built a network and a reputation among these energy firms that they have high quality companies in the portfolio. So they can make certain assumptions about their own ability to pick DPI firms and to influence the path to DPI. And that to me is what this discussion point of liquidity is about.
It was episode 127 with Renee Savelsberg and Julia.
Okay,
Patton.
I'll go back to it. It's my go-to firm when it comes to energy topics.
Really cool. That's cool to hear. Well, now, of course, they're also on the go-to podcast then. Let's go to the final one in the 7 questions, the discipline question. What will make you stick to your game when your ecosystem shows you other deals? Tell me about that while I mute and say hi to my son.
Yeah, so discipline. I'm sure every GP that is underway for a while has had this occurrence where, hey, someone shows you something outside of your investment scope. Maybe you're dedicating only to Europe and a buddy shows you an interesting deal in the US. Or maybe you're doing only Europe, someone shows you Israel. Or maybe you're investing in construction tech and someone shows you something in prop tech. And so whenever it's just a little or later stage, a higher valuation, lower ownership target that you have set out, what makes you stick to your discipline to say outside in no? That's the question. It doesn't mean that you have to say outside in. By all means, take the call. If you have the time, in the end, it's only you who can make the prioritization. But the question is, what would make you say no outside in? If the answer to that you cannot clearly define, I would say you probably don't have as strong a differentiation and strategy set as you think. And that's discipline. And so the other thing, to your point here, Andreas, that you shared with me in the show notes might be processes. You asked me, hey, Patrick, what processes do you have that makes you stay disciplined? honestly, I don't know, Andreas. I don't think we have hyper-specific structures or processes. I think it lies in the people, in the persons, how they prioritize. I tend to be a person that is hyper-prioritizing. And I actually tell my colleagues, I think the number one across the world underrated business skill is prioritization. If humans were better at prioritizing, we would get 10 times more shit done in our lifetimes. So to me, I think it comes down to prioritization.
Yeah, so I have 2 children. So that definitely helps me prioritize.
Yeah.
But let me just make a comment on the discipline part here. I think 2 things. One, obviously, it's okay to veer outside of your strategy. That is why you have, you have an LPAC that you can ask. It's why you have typically 20% or so that you're allowed to do outside of your core focus without having to ask anyone. Those things, it's why you have a max amount that you can go outside of your normal check size, without having to ask anyone, all those things. So it's absolutely okay. There's also a reason why I think the famed investors would all say that we have a strategy until we don't, so to say, right? Or there's no price that will not let us do a round, or so to say, decide to invest. My son just joined us, for those watching on television. I've told him he can be here, but he cannot.
Yes.
He cannot say anything. Let's see how he does. So I think that on that point, it's incredibly important to remember that you can veer away from what you plan to begin with, but you have to have a very good reason to do so. And that is where I ask you about process. One thing is inside a firm, you can have that, well, okay, this is how we do it, but it can also be your own thought process. These are the tests that I run through with myself to make sure that this makes sense.
I have 2 tests before I test inside of my own head. And now you've actually reminded me of 1 or 2 occurrences where maybe in the firm's processes this happened. Let me share those with you. Before I do, 1 quote that a business person that I admire taught me verbatim that relates directly to what you said. So the counterexample to what you said was this person's mantra, and that is, you have a strategy when you know when to say no. You have a strategy when you know when to say no. Doesn't mean you always say no, but when you know when to say no, that's when you have a strategy, because it is clearly defined boundaries. To the question, so first in my own head. So 1, why does that person show me a deal, or why does that founder come to me? If the answer to that is very obviously aligned with what I stand for, what I know, what I have empathy for, what I have routine repetition in, there's a good chance that maybe even if it's outside of my scope, it should be something that I should consider. And 2, the second question is, why can I help this firm? I have passed on many deals that are somewhat, at the fringes of our scope. I will not tell you which ones, but I oftentimes see something in a wider manufacturing space where people think, hey, in that part of manufacturing, it's relatively close to what you're doing. And I've repetitively passed on companies in that specific part of manufacturing because I say my competence doesn't translate there. It's not project-based. There is not a lot of service elements to it. It's more pick and pack. It's more e-commerce. Even though it is manufacturing, it doesn't share the characteristics of what I have empathy and routine for. And ergo, even if they feel I'm a preeminent person to ask you to take a look, I won't have the ability to accelerate this firm. And so if it's not obvious why I'm being asked, and it's not obvious why I can help the firm, in my mind, that's 2 questions that in my thinking process help me prioritize. In our firm, it's the weekly meeting where actually, if you participated, Andreas, you would not believe how unbelievably adversarial our weekly meeting is. And people sometimes get a little bit, so like new joiners, sometimes they have a trauma after the first time we meet Mondays, because it's there's no filters. I think we could do a better job on highlighting what we love about a firm and what could go right here. I think we're trying to get better on that front. But on the other side, we're very, very good at actually pointing out when we're not a preeminent investor or it doesn't make sense. So there's a little bit of that group dynamic where we all ask ourselves that question.
I think all good investment meetings are held on Mondays because you have to make sure that you have 4 days to just rebuild rebuild love in the firm after you've battled it out. All right, Patric, let's go to the last one, the body test. We've touched on it in the beginning, so I think it's really nice that we come back full circle and just revisit the body test and why this one is so important.
So if the body test is asking yourself to test your own differentiation and strategy, why will your buddies call you? And if the answer to that is not obvious, or the answer is, well, because they're my buds, or because we're best mates, or because we know each other very long, that in itself will obviously not scale. You're probably not the only person that could claim that same advantage, and you definitely can't have that same advantage with 10, let alone 100 people. So there needs to be another reason why these people in their immense WhatsApps will actually think of you. And so if you can answer that with something else that is not, hey, because we're best mates or we know each other very, very long, or I was the best man at his wedding, if it's not that answer, then you might have a real edge here.
Yeah, you're calling it the body test. I'm sometimes from the LP angle calling it the national champion or the global champion test. It's so difficult if you don't have a lot of experience in a space to be able to diligence whether someone is only a national champion, only in quotation marks, or a global champion. But the fact of the matter is that venture is a global game. And in many cases, it's not enough to be a national champion. Or in the national championships, maybe you can be a national champion, but if you're only in the championships, to a non-qualified person, you would look like you're the best guy on the field. I've never seen anyone run or play like that. But then if you've met someone who is actually a global champion, you realize, wait a second, this guy wasn't actually as good as I thought. I also say to many, and this is on the business angel side or the family office side, when they're investing in obviously small-sized family offices here, but the people that haven't done a lot of LP investments and don't have a big framework for it, one thing they have done is they've hired a lot of executives typically. And I sometimes say it's maybe easier for you to think about this as a hiring. You know, if you're hiring for someone to do this job, would you hire this person? And that's oftentimes a framing that's easier for them than the framing of, will I invest 200K or 500K with this guy? Patric, what a conversation. Thank you so much for joining for it. It's been incredible. We're going to do so much fun stuff together, I'm sure.
Thank you for having me.
Here's a few words from our beloved sponsor.
Welcome to the European VC podcast, sponsored by Flow. Combining technology and regulatory rails, Flow is enabling the private markets. For the VC market, Flow is working with integrates every aspect of fund management. From creating investment management agreements to handling custody services and regulatory reporting. This unified platform streamlines the administrative workflow, enhancing communication with limited partners and simplifying payment processes. A standout feature is the Flow Certificate, a globally tradable instrument that boosts liquidity and facilitates secondary market transactions, reshaping fund structures with more flexibility. As Martijn, CEO of Flow, puts it, by modernizing fund structures and enhancing liquidity, we're empowering investors, VCs, and innovators to grow significantly.
Yes!
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.